Welcome to Stocks Telegraph. In the world of investing, market cycles can play a significant role in your investment success. Knowing how to identify and prepare for bull and bear markets can help you make better investment decisions and potentially increase your returns. In today's video, we will dive deep into the topic of bull and bear markets, exploring what they are, how to identify them, and most importantly, how to prepare your portfolio to navigate them successfully. So, sit back, relax, and let's get started. Let's start by defining what bull and bear markets are. In a bull market, the stock market is on the rise and investor confidence is high. This leads to an increase in stock prices and overall economic growth. Conversely, in a bear market, the stock market is declining and investor confidence is low, leading to falling stock prices and a potential economic recession. Identifying a bull market can be crucial for investors to take advantage of the positive market conditions. One of the key indicators of a bull market is a sustained period of stock market growth, typically measured by an index, such as the S&P 500. During this time, stock prices tend to rise, and the market is generally optimistic. Investors may also see strong investor sentiment, with many feeling confident about the economy and willing to take on more risk. In addition, low unemployment rates and increasing consumer spending are also signs of a bull market. This is because during a bull market, consumers are more willing to spend money due to increased confidence in the economy, which leads to overall economic growth. It's worth noting that bull markets can last for years, and investing during these periods can be very profitable. However, it's important to remember that all markets eventually experience a downturn. Therefore, investors should always be prepared for a potential market correction, and have a well-diversified portfolio to help mitigate risk. If you believe that you are in a bull market, you may be tempted to invest in stocks, but it is important to proceed with caution, and not get carried away by the hype. First and foremost, ensure that you have a well-diversified portfolio that aligns with your financial objectives and risk tolerance. Investing in sectors that typically perform well during a bull market, such as technology or consumer discretionary, may be beneficial. It's important to remember that even in a bull market, there will still be ups and downs. The market can be unpredictable, and sudden shifts in sentiment or economic conditions can cause fluctuations. So, it's crucial to stay vigilant and regularly review your portfolio, to ensure it is still aligned with your objectives. Additionally, resist the temptation to chase high-flying stocks or jump on the latest market trend. Doing so could lead to costly mistakes and overexposure to specific sectors or companies. A disciplined approach to investing and sticking to a long-term strategy is key. Lastly, keep in mind that bull markets don't last forever. So, it's important to be prepared for a potential downturn and have a plan in place. Consider setting aside cash reserves or investing in more defensive sectors that may be less affected by market fluctuations. And always remember to keep a level head and not let emotions drive your investment decisions. Now, let's delve deeper into bear markets. As we previously mentioned, a bear market is a period of declining stock prices, and a general lack of investor confidence. This market condition can be caused by various factors, such as economic downturns, political instability, or global events that negatively impact investor sentiment. One of the most significant signs of a bear market is a sustained period of market decline, typically lasting for at least a few months. During this period, investors may experience losses on their investments, leading to increased anxiety and pessimism among market participants. Negative economic news, such as reports of rising inflation, declining GDP growth, or increasing unemployment rates, can also contribute to a bear market. Another key indicator of a bear market is increased market volatility. During these periods, stock prices can fluctuate more rapidly than usual, making it challenging for investors to make informed decisions. You may also see increased pessimism among investors, as well as a general sense of fear in the market. This fear can lead to further selling and cause stock prices to decline further. If you believe you are in a bear market, it's important to take steps to protect your portfolio. One strategy is to consider moving some of your investments to more defensive sectors, such as healthcare or utilities, which tend to be less affected by market fluctuations. Additionally, diversifying your portfolio further by investing in bonds or other fixed income securities can also help reduce the impact of a bear market. It's also crucial to be prepared for potential job losses and economic recession, by keeping an emergency fund and avoiding taking on too much debt. Remember that bear markets can be challenging to navigate, but they are a normal part of the market cycle. By staying informed and taking proactive steps, you can help protect your portfolio and come out stronger on the other side. In conclusion, understanding how to identify and prepare for bull and bear markets is essential for any investor looking to succeed in the stock market. Remember to approach investing with caution and not get caught up in the hype of a bull market, while also being prepared to protect your portfolio during a bear market. Thanks for tuning in to Stocks Telegraph. We hope you found this video helpful in understanding bull and bear markets, and how to prepare for them. We'd love to hear your thoughts on this topic, so please feel free to share your comments and questions down below. And don't forget to subscribe to our channel for more informative videos on the stock market. For even more detailed articles and stock market news, be sure to check out our website at stockstelegraph.com. Thanks again for watching, and we'll see you in the next video.